Le pido yo al equipo de producción, que es otra sorpresa que le tenemos, que nos ponga en la pantalla al siguiente invitado, que también es una persona que efectivamente conoce muy bien lo que sucede en el mercado, que es un excelente analista, estratega, presidente de una compañía importante que tiene dentro de su espectro todo lo que son los servicios de manejo de dinero, Kevin Simpson, y efectivamente estamos muy contentos. Vamos a preguntarle precisamente lo que piensa del mercado y qué podemos nosotros ver de otro analista que indudablemente aparece en todas estas otras cadenas y está ligado a todo el sector institucional. Kevin, thank you for coming. Super happy to have you here at Negocios TV. And I think that the first question is, Kevin, what's going on? What do you think is happening with the non-farm payroll tomorrow? Next week, we're going to have the Fed meeting, and the Fed probably is going to change the language. But I want your opinion because obviously you might be taking into consideration several other factors. Thank you for coming, Kevin.
Thank you for having me. And I'm excited for the non-farm payrolls tomorrow. They will certainly be the biggest news of the week. We've had a lot of data points already, none of which were stellar. Nothing knocked the cover off the ball. First read of GDP was down. The PCE from an inflationary standpoint was even. But last month, they ticked it up a little bit. So you're not seeing inflation coming down. And then you have consumer sentiment and retail sentiment at levels, Victor, that I can't even remember seeing. I mean, literally, the consumer sentiment number being at what we saw back in March of 2020 is very, very difficult for me to comprehend. Because for those of you who remember, March of 2020, we were in the middle of a shutdown, a global shutdown because of a pandemic. Tariffs are scary and people are freaked out. And I'm not suggesting that anything's calm or collect right now, but to see that comparison is a little crazy to me.
Listen, I agree with you, but a few minutes ago, I was speaking with the Chief Strategy Officer of Raymond James, Matt Orton. I think you know him personally.
Sure.
And Matt was super bullish. And if you talk to Tom Lee, he's super bullish. And if you talk with Ed Jardini, who we were able to interview yesterday, he's also super bullish, even though he didn't rule out a couple of quarters of stagflation. Obviously, there is a lot of bad news. You see a lot of people completely set for another leg down in the market when you measure the statistical data of how people is positioned, and the institutional guys with terms of short positions, and you also have nothing out of the White House. But you still seeing today that we are basically over the 5,600 basically mark, and it's very difficult to argue today with the bullish case that we have in front of us. But in any case, what do you think is what we need to take into consideration? Because even though I'm cautiously optimistic, Kevin, I think that we might revisit the lows of March if worse comes to worse and something happens where, let's say you and I go to the next door store and you don't find anything like what happened on the COVID era because there is no inventories and stuff like that. What do you think it might go wrong in your opinion for the next couple of quarters, Kevin, please?
I'm not quite as bullish as my good friends that you mentioned, Victor, but I do think that longer term there's opportunities to buy here. And certainly last month was a tremendous buying opportunity. Anytime you see a cascading market that's down 20% peak to trough, and we saw that, you tend to be able to, if you have a long enough time horizon, be very, very well rewarded. But I still think about this contrarian view where we talked about consumer sentiment at levels we hadn't seen since the pandemic. You're asking about inventory. I think companies, unlike during the pandemic, pre-days or planning for tariff uncertainty. And that's why GDP was really down on that first print. It was not because we saw a slowdown in growth. Even if we did see a slowdown in growth, we certainly didn't see a deceleration into contraction territory, but people were getting ahead of everything and building up inventories. Doesn't mean you won't see empty shelves in certain categories, but the thesis, the consensus is that maybe the tariffs, when it's all said and done, won't be quite as bad as we thought when we heard that worst case scenario. So cautiously optimistic, I think, is the right term that you used.
And listen, I would like you to explain this a little bit in a completely different topic. What are you doing in terms of fixed income? Because obviously on portfolio construction, the typical 40-60 is break, but people are still thinking that, you know, if we might go to some sort of, I don't want to say deflation, but there is some cases out there for potential deflation in the fourth quarter. And there is people like from PIMCO they are thinking that at this level, you should start accumulating some sort of the 10 years. And I'm not quite sure. I think we will still have to see what's going on with the deficit and obviously the financing in the Congress. But what do you think will happen with fixed income? Are you putting your clients able to buy AAA corporate? What do you think about the munis? And in that area that is super important for everyone's portfolios.
I'm going to tiptoe around this answer because I'm an all equity manager. I've never owned a bond in my life, but I will say, speaking in defense of our good people at PIMCO, who are bond managers and experts in that field, if the thesis is that the Fed will be cutting rates, and I think that we will see rate cuts either for one of two reasons. A good reason would be we see inflation come down, the Fed's too restrictive and they cut rates. I think we all thought that was going to be the case in January, which just goes to show you that you can't always expect everything to have the outcome that you desire. Or number two, because we go into recessionary pressure where the Fed's cutting rates to re-stimulate growth. In either of those instances, rate cuts or a rate cutting cycle would be really constructive on anyone who makes fixed income investments when rates are higher because of that inverse relationship. So if you're under the opinion or of the opinion that rates will be lower a year from now, probably adding some 10-year exposure to your fixed income portfolio would be a good play. If for some reason you think that rates are going to go much higher, then you certainly don't want to be on the 10-year or longer end of the yield curve. You'd want to keep your maturities very short and very tight. But I'd listen to PIMCO. They know what they're talking about.
Excellent. Listen, in another topic, you and I know our great friend Anthony Scaramucci. He's become an evangelist on Bitcoin lately. And a couple of weeks ago, I was able to interview Matt Hogan from Bitwise.
Sure, yeah.
And they were seeing a kind of a flow of potential, let's say, portfolio managers to allocate when the time comes more and more on behalf of families to the ETF. What do you think about Bitcoin? And obviously, this is a phenomenon because even though there was some drawdowns, I think we revisit the 70-something back in the first week of April. We also been seeing the Bitcoin, winning slowly but surely, and I think we want to see 100,000 soon. But I want your opinion on that potential asset class. Let's put it that way, because it's on everybody's radar screen, and if we see 100,000, we might see 120.
Oh, I know we saw 110. I am no Bitcoin expert. I leave that to Anthony and Matt, but I think it's great because I'm commenting on bonds, which I don't manage, and fixed income, which I don't know. But I will tell you this. My son and all his friends are in Bitcoin. They're in it like I've never seen anybody. Now, granted, they don't have a lot of money, but when Bitcoin was at 55,000 last summer, every single one of them was blowing up my phone when it got to 110,000, and they were telling me how smart they were and how it's going to go to 1 million. I think as a storage of value in an asset class, it's certainly matured enough to be part of the conversation. I don't invest in Bitcoin or any of the surrounding halo of it. But I do think that with a lot of the financial advisors that we work with, who certainly have allocation to fixed income, so it's part of the dialogue, how do our equity portfolios pair with fixed income, I think there will be a day when that conversation of how crypto is part of that asset allocation. Right now, I think the advisors that we tend to work with are using a 1% to 3% exposure if they're using it with their clients, and that provides validity to the base case of having it provide some liquidity. As far as an application or use case, maybe I'm just too old, but I don't see that yet.
Kevin, and 3 weeks ago, I was speaking with Adam Parker, and Adam was telling me, Victor, no matter how you see the picture, you got to keep defensive. Utilities, healthcare, play safe in this environment that, yes, it's sure any tweet can change the rules, but it is a lot of volatility, and I don't think that retracing anytime soon. In terms of the sector, which is your area in the equities, out of the 11 sector, where do you think we should be buying dips or positioning? You mentioned that a couple of weeks ago we got great opportunities, but for the midterm and long-term, opportunities are always out there. What are the sectors you like the most, and probably why? And what you will do if you have to deploy money now in the next few, let's say, days?
Well, the next few days, I'd be a little bit patient because we've had such a run up this week, and we may see Apple and Amazon do something similar to what we saw with Meta and Microsoft yesterday. And if that's the case, you probably don't want to be chasing positions. that you really like at such elevated values, comparatively speaking, over a 2-week period. I think people will always pay up for innovation. Therefore, we have a 25% allocation to technology. And granted, that's light. That's lighter than any of the indices. But like Adam, I'm always thinking about the belt and the suspender. I like to be very conservative. Every company that we invest in, regardless of sector, and I'm highlighting technology because I think there's an opportunity there, you're going to be looking for things that, for us, pay dividends. So it takes away some of the whipsaw names. Maybe we can't own the NVIDIAs or the Teslas or the Netflix, which I think is an amazing company, but we own some things that are a little bit more boring, the IBMs, the Apples, although Microsoft, which is another name that we own, had a pretty good day yesterday, as did Meta. But we're always thinking of looking at it from a valuation standpoint and trying to look for stocks that are underpriced, that are beaten up, that go down for broader market reasons, that have a little bit better valuation. So we tend to participate a little bit less to the upside, but more importantly, I think over the long term, is we participate a little bit less into the downside. Looking for things that are tariff agnostic is fun to talk about, but it's hard to find things that don't have exposure to tariffs. One name in particular that we have been adding to that's done very well all year is TJ Maxx. And if you think of a retail space, all of these companies are subject to tariff exposure to China, including Amazon, which we'll hear more about. But the one thing about an off-rack retailer like TJ Maxx is that they're buying inventory that's already here from other companies at discounted prices. So tariffs aren't necessarily a piece of that thesis. So lots of great opportunities out there. It's just you want to be careful with your timing, and certainly having an intermediate to longer term time frame lets you sleep a little bit better at night.
Listen, it's 3:45 p.m. Eastern Time, 9:45 in the night, and basically in Madrid. We have 30 seconds, but I was wondering, as you know, I speak with portfolio managers, banks, owners, broker-dealer owners, fund managers in Latin America, the private equity guys, the hedge fund guys. Do you have any exposure? Do you like Brazil and Mexico at this level? Because obviously those countries might benefit. If you hear what the President Chambon was saying today about the call between her and President Trump was nice. And obviously Brazil might have some sort of opportunities if worse comes to worse between the US and China. What do you think about Latin America? And summarize that, because obviously it's my region and I love it.
Well, we do run an ETF IDVO. So I have a purely international, non-US based exchange traded fund. We've had tremendous success with the Mexican trade since the beginning of the tariff conversations. But if you pin me down for one country, I still think there's opportunities in Brazil that shine above most of the others there. And if you dig into it, I'd be a buyer of whatever allocation we can make within that portfolio to some great companies in Brazil.
Listen, I love your energy, your passion. I definitely want to invite you again to interview you. I am with you a little bit more cautious, but you know, we don't know what's going to happen, and somebody's definitely buying in size. Let's see what happened today with Apple and Amazon, and I'll get you back in the show soon. Thank you, Kevin. Thank you for taking the time.
Thank you, my friend. I'll see you, Victor.